If you're looking to find an ideal business, that's what we do. We also have a franchise team where we help you identify a business that fits your lifestyle, your goals, and your financial capabilities. So we kind of pair both together because they work well. You want financing, you want to figure out how to buy a business. That's a big chunk of it. And then what business do I want to buy? What would I excel at? What fits my current lifestyle? I'm currently working a W-2 job, but I want to build a business. That's all fine. We have different business models, franchise concepts that can align with your goals. And obviously, my goal is to help 10,000 aspiring entrepreneurs over the next 10 years become entrepreneurs by either influencing them on my podcast or talking to them one-on-one, helping them find a business, helping them finance a business, and that's what we do. Hello, welcome back to another episode. Today we're going to talk about financing RV parks. I was on a call earlier today. A gentleman called, he saw one of the episodes on our channel here, and he was looking at doing an acquisition, and he thought SBA financing would be the best option. So he's going through the deal, and everything sounded okay, but then he told me that the RV park had long-term tenants. So he was going through that they pay, they're doing 6, 8, or 12-month lease agreements. And for SBA purposes, they're not going to use long-term rents. So if half the park was daily and half the park long-term, they could only use the daily rents. They wouldn't use the long-term rents in the cash flow for cash flow purposes. So that's why mobile home parks are not SBA eligible, because those are usually long-term lease agreements for the pads. So anyways, I want to point that out, that you just got to be careful on these deals and why mobile home parks are not typically SBA eligible, and RV parks are. However, if you have long-term agreements and they're not daily stays, weekly, and they're over 30-day stays, then that income would not be eligible for SBA financing, and the project probably wouldn't be eligible for SBA financing. Same thing when you deal with kind of a mixed use property. You're moving in downstairs, and that's going to be a coffee shop, and then there's 3 apartments upstairs that are long-term rents. That's okay as long as the coffee shop is occupying at least 51% of the space, but we're not going to be able to use the long-term rental income for the purpose of DSCR, debt service coverage ratio. So that won't be allowed in. So if the coffee shop numbers do not support the loan amount, then you could be in trouble. Now, some people would say, well, what if it's a short-term rental? Maybe that could probably work if short-term rentals and you could tie it into the business somehow, but that's kind of a gray area. But there's always ways of structuring deals, and I just wanted to point out a few things that I see as people call me and I get questions. I get a lot of calls for they want to finance multifamily with SBA. You can't do it. You want to finance mobile home parks. You can't do it. Remember, this is operating businesses. Self-storage is SBA eligible, and that came into legislation in the SOP, I think, in 2010. And so it's interesting because that's construed as a business versus multifamily is not a business. Now, a property management company, you can buy a property management company. That's a business. So you can do certain commercial real estate deals that are construed as businesses, but if it's an investment, then it's not going to be eligible for SBA. Now, what are your options for financing this RV park where it's got long-term tenants? That's probably going to be a bank, credit union, community bank, regional bank, credit union, potentially kind of depending on the loan size. Maybe there would be an option for some sort of CMBS loan would also be a possibility. So those are kind of the considerations I would make aware, because I've gotten a lot of calls recently on the RV park. So just remember, if there's long-term tenants, it's probably not going to work. But really, most other businesses that you are running and that your business will occupy at least 51% of the space if there's commercial real estate involved, those should be eligible as long as it's not a mortgage brokerage or mortgage lending office There's a certain amount of ineligible businesses that are on the list, but gas stations and property management companies, CPA practices, financial planners. Uh, if you have a business already, you can move into another building. If you're paying rent right now and you want to buy a building, as long as you're occupying 51% of the space, we call that rent replacement deals. If you're building a building, you have to occupy 60% of the space for new construction. Day one, within the first 2 years, I believe you have to occupy 80%, with the intention of occupying over 100% within the next 10 years. So you can do new construction. Either a 7A or 504 would work. I also often have this conversation, the 7A versus the 504, when to use the 7A, when to use the 504. Obviously, the 504 is going to be brought in when we're doing CRE deals, but does it always make sense because the rates are lower? No, not necessarily. It's a first and second. The second lien's got a 10-year declining prepayment penalty. The first lien is going to be negotiated as far as the prepayment penalty versus doing that same deal with the 7A. And the 7A, anytime the term's over 15 years, you're going to have a 3-year declining prepayment penalty, 5.3 or 5% the first year, 3% the second year, 1% the third year. And if you're doing any sort of value add type of RV park that you're going to add more pads and you're going to increase revenue, you don't probably want to lock into a 504. And sometimes a 504, if the property is considered special purpose, like a gas station or something like that, they're going to give you a 5% haircut. So they're not going to do 90%. They're going to do 85. And if it's a startup, they give you another 5% haircut versus the SBA 7A might be able to do 90%. And remember, we always talk about banks all read through the SOP from the SBA, but they all interpret the rules a little bit different. And so that's why they coined the term prudent lending, and each bank has different prudent lending guidelines. So my advice is to contact somebody like myself. Doesn't have to be me, but can be me. If you want, you can go to bookwithbeau.com and schedule a call. But we can dive into, what can be done, what can't be done. And usually if you're doing a business acquisition, the biggest thing I can tell you is that really get the tax returns from the business that you're going to buy or you're looking at buying, because that's really going to be the number one factor is this business profitable? Can the cash flow support the new debt payment? And if not, is there a reason for it? Is there expenses that will not be incurred once you take ownership? Is the current owner running personal expenses, cars or different things through their business where you won't have those expenses? So get an understanding there, first off. And then from you're going to need 3 years of financials. So 3 years of tax returns. You're going to need a resume. You're going to need Form 413, which is a personal financial statement. With that initial information, we can typically take that out to our bank and lender partners and get you a term sheet. And then the question is how did the rates differ? Well, on the 7A is based on Wall Street Journal Prime plus a margin. 90%, give or take, are variable rates, meaning it's not going to be a fixed rate. If it's just a business acquisition with no real estate, it's going to be a 10-year term. If there's real estate involved, depending on the purchase price of the real estate versus the business, the amortization could be as high as 25 years. So these are all factors that we can help you figure out. Should you do a 7A? Should you do a 504? Can you do a 504 with a 7A? Lots of ways of structuring these deals. At the end of the day, if you get the documents up front, the seller's financials, it's going to make the process quicker. Meaning we can get you feedback very quickly. But trying to give us P&Ls, or just the last year P&L is not really going to do any justice for you. So that's my first suggestion. So if you're watching this right now and you want SBA financing, you got to get the tax returns from the seller. You got to get the business tax returns. Get the past 3 years. They probably don't have 2023 done yet. You're going to get an end of the year P&L for 2023. But this is how we're able to help you the most if you take the action and get these items. And then on your side, you're going to have to do a Form 413, which is a personal financial statement, 3 years tax returns. Resume or bio is very helpful. Usually, if you're buying a business, you want to be somewhere in the vicinity because the banks usually want to know that you're going to be able to, supervise and manage that business. Sometimes you can tell the story why you live in California and are buying a business that's 8-10 hours away, and you're going to be able to effectively manage it. But most banks want to know that you have a plan to move there or be there, consistently to run and make sure that business is successful. Now, banks are all different as far as rates and terms on the 7A. The margins can be as high as 2.75. So it's Wall Street Journal Prime plus margin is your rate, and then it would adjust when the Wall Street Prime rate adjusts. And so there are banks that will do fixed rate options on deals with or without real estate. With real estate, you see it a lot more that you'll get fixed rate options and you'll get a little bit better terms because the deal's more secure, right? It's got collateral. If the loan amount's over $500,000, SBA guidelines will require the bank is going to look for additional collateral. So if you have real estate and your loan amount is over $500,000, they will look to put a secondary lien or first lien on that real estate. So be aware of that. If you don't have any other collateral, that's okay because they can still make the loan. It's just that you need to know these things up front so you can best strategize on how to finance. When we talk about loan to value, we really don't do loan to value. We do LTC, loan to cost. So with an SBA loan, you can purchase price plus working capital plus any marketing, and that becomes your total project cost, and you can borrow up to 90% of that. And you can even sometimes have the seller carry back some of that 10% down payment, or we call equity injection. So you can also have them do a carryback as long as it's on full standby, which means that there's no payments made for the first 2 years of the loan. It can accrue interest. So you can limit your equity injection or your down payment by structuring a seller financing on full standby. So be aware of that as you're structuring your deals.
Meet Beau, the driving force behind Business Ownership Coach, unlocking the path to business ownership. Visit www.businessownershipcoach.com. Thrive with Business Ownership Coach.
That is my rant for today. Anything SBA, anything business acquisition. If you're looking to find an ideal business, that's what we do. We also have a franchise team where we help you identify a business that fits your lifestyle, your goals, and your financial capabilities. So we kind of pair both together because they work well. You want financing, you want to figure out how to buy a business. That's a big chunk of it. And then what business do I want to buy? What would I excel at? What fits my current lifestyle? I'm currently working a W-2 job, but I want to build a business. That's all fine. We have different business models, franchise concepts that can align with your goals. And obviously, my goal is to help 10,000 aspiring entrepreneurs over the next 10 years become entrepreneurs by either influencing them on my podcast or talking to them one-on-one, helping them find a business, helping them finance a business. And that's what we do. So hope you enjoyed this episode, and please like, subscribe. And by the way, March 2nd, we're doing a live virtual event called Business Ownership Summit. You can go to businessownershipsummit.com and RSVP. It's going to be an action-packed day. It's a Saturday. It starts at 9 a.m. Pacific. And we're going to talk franchising. We're going to talk laundromats. We're going to talk about passive investing models. We're going to talk about the top low-cost franchise models. We're going to talk about matching and how do we use a scientific approach to find the ideal business for you. We even have a CPA, Michael, who's going to come and show you what the advantages are, even if you have a W-2, how that can help you even more by owning a business as well. A lot of people don't realize the extreme tax advantages. I believe with the tax advantages of owning small businesses that you should really look into owning a business, even if you plan on keeping your job, because there's huge advantages and you can grow your net worth and keep more of your money by owning small businesses. So anyways, go to businessownershipsummit.com and I'll see you on the next episode. Hey guys, Beau here. If you enjoyed what you saw, please subscribe to this channel. We talk all things financing. I've been in the lending industry for over 20 years, and I'm happy to answer your questions and provide great content.